Hi everyone, welcome back to my channel. This video is going to be a little bit different. As you can see, I've got a calculator and a couple of random props here. In past videos, I touched lightly on the topic of personal finance and specifically my views on saving and investing. And I had mentioned that I was investing in LVMH. That is the parent company of Louis Vuitton. I am obviously a customer. If you've been here before, this channel is pretty much all about luxury and designer goods, and I have been a customer of Louis Vuitton for a couple of years now, and I have decided to recently invest in their stock. So I am now an investor. I actually purchased a number of their shares a couple of different times over the last year or so, and so when I mentioned that, there were a flurry of questions about just investing in general, how to get started. So I have decided to finally make this video, and I will try my best to answer all of your questions, but I do think it may get quite long because there were so many questions and so many requests that I received over the last few weeks. Some of the recurring questions that I received were, how much should I save? How much should I save depending on my age? How much should I save in order to retire? Which is a very personal question. We'll try to get into that. Also, how do I start saving and how do I start investing? Like the baby steps. How do I get it set up? So hopefully I can give you some tips on how to get started. And then where should I invest my money? That was a common question. Also, a lot of people had asked, what is compound interest? Because I had referred to compound interest and the magic of compound interest a few times, both here and also on my Instagram. And so many of you asked me to explain the beauty of compound interest, which I will do. I've actually created some charts with some fake numbers to show you how it works. And then also there were a lot of personal questions, such as what is my own personal savings strategy, my investing strategy, what does my current asset allocation look like, when did I start saving, how did I get started in the stock market, etc., etc. But I will probably lightly touch on those questions towards the end of the video if we have time. I won't get too deep because a lot of it is, it's quite personal and quite private, so I won't use my actual numbers, but I might be able to share some percentages. And then finally, at the very tail end of the video, I would like to share with you some resources because I am not an expert. I am just talking about my own personal views, my own personal financial principles, and what I've been doing over the years and what has worked for me, as well as what has not worked for me. I've definitely made some mistakes. It's been trial and error over the last few decades, but I want to leave you with some resources at the very end because there are people out there who live and breathe this stuff, and they're not financial advisors. They don't get commission for putting out what they put out. They're just super passionate about their own financial empowerment and education, and they like to share information with others. So I will share with you a few of my favorite YouTube channels, a book also that my husband wrote. So I'm a bit biased, of course, as his wife, but it's a really compact, clear, concise book that he published not too long ago that has been doing pretty well. And it basically mimics all of my own personal saving and investing principles. So we are pretty much aligned. So it's almost as if my voice is in there as well. And you'll hear a lot of echoing in that book. So if you want to pick that book up, you can do that as well. Okay, so first, I want to start with a disclaimer. Like I said, I'm not a financial expert. I'm not a financial professional. I don't work in the finance industry. I have 0 credentials that make me an expert in this area. Also, this video is largely going to resonate with my US-based viewers. Okay, so if you are American, a lot of what I'm going to say is basically appropriate for you. If you live outside of the States, then it may not be as relevant because I know that in different countries there are different financial systems and different savings vehicles and different government support. So not all of this might be applicable to outsiders, meaning outside of the US. But I do hope that there are still some basic tips and tools that will be helpful to everyone. Okay, so just a little bit about me. Since many of you asked, I have been saving since I was a child. Luckily, my father in particular was very, very passionate about teaching me about money at a young age because both of my parents were small business owners and they had that entrepreneurial spirit. So I remember saving at a young age in my piggy bank, and then when that piggy bank got full, it was actually a plastic Smurf, like about this tall. For those of you who are around my age, you may remember the Smurfs. And my dad and I, we cut that Smurf in half and pulled out all the money. And then my mom and I went to, it was Citibank at the time, and opened my very first traditional savings account when I was about 10 years old. And at the time, the interest was really, really good. So I was earning so much interest on my little, allowance money that I was putting aside, birthday money, gift money from grandparents, etc. And that grew. And eventually, long story short, by the time I got married when I was 25, I had enough money in there that I could pay for a good portion of my own wedding. So that was really a beautiful thing. And then I started investing in the stock market right after college, around 21, 22 years old. My dad had been on the side, kind of like a day trader. And so although he didn't really teach me, I saw him doing a lot of the stock trading and it intrigued me. So I read up on it and I basically self-taught myself on how to get started, made a lot of mistakes, but I luckily was playing with like a small amount of money because I was broke as a 21-year-old. So that worked in my favor. So there weren't any incredible losses, but definitely some regrets in terms of wishing that I had started differently back then, because then I think I would have a larger nest egg now, but you live and you learn. So that's kind of my background. My dad always said to me at a very young age that you don't become rich or you don't become wealthy based on how much you make. You become wealthy based on how much you save, how much you put away. And he said that to me from a very young age, and that really stuck, especially because they were like lower middle income class and really, hardworking immigrant life, achieving the American dream. Sometimes I wondered, how do they even make everything possible? How do they even make ends meet and give my sister and I everything that we have? So just watching them go through it and being a witness to that really was like the proof in the pudding for me. And so I followed that principle and save as soon as I can. And that's what I did. Currently, I am married. My husband and I live in Manhattan with our 2 children. We have been debt-free for over a decade, thankfully, and have been able to build a decent nest egg, although, of course, it's still a work in progress and we have a way to go. But I feel really blessed and fortunate to be in the financial position that we're in. We have real estate that we own debt-free, which also has been a blessing. That gives us some passive income on a monthly basis. So that's kind of just about me. And this is in no way, shape, or form trying to like brag about my situation, because I'm sure there are people watching this video right now who are in much better financial situations than I'm in. So this is not a comparison of any kind. But I think that it's important to know kind of where I stand, my life stage, and where, just my kind of story, so you can hear where I'm coming from, my perspective, because everyone's got different life circumstances. And also I did receive a lot of questions asking about these personal kind of pieces, so just wanted to share kind of candidly. Okay, and then I know this is a lot of talking. I told you this may be a long video. If you want to stop and get a snack or a drink or take a bio break even, or just like put your earbuds in and walk around and listen to this almost like podcast style, because there's really not much to see. I will be showing some numbers and charts and some calculations later on, so you may want to tune back in and look at the screen at that point, but until then you may just want to like make it an audio. But the message I really want to put out there up front is that it is never too early to start saving, and it's certainly never too late to start saving. Okay, I know a lot of you feel like, oh, I am, now in my 40s, I'm in my 40s, or I'm in my 50s, I'm too late now. No, it's never too late. Or some of you are like, I'm 19, I'm 20, maybe I shouldn't even be thinking about this. No, you're smart, you're wise to think about this early on, because the beauty of compound interest, and we will get to that, we will. Look at all my notes here. I've got like a stack of notes and highlights and research, and I didn't want to just talk off the cuff. I wanted to be prepared, because money is a very, fragile topic, and I didn't want to just throw anything out there. So I hope this video is going to be helpful. So I recently conducted a poll on my Instagram, for those of you who follow me there, and I asked a series of questions related to money management, and it was very interesting for me. It was really eye-opening just to kind of hear the different answers. When I asked, how much do you want to have saved before you retired, the number one most common answer was $1 million. Yes, $1 million. I'm sure you're not surprised. That is a very common kind of like round number, I suppose. And then that was followed by lots of questions to me, which I found kind of interesting because I am not in a position to answer this question. But the next question was, I want to have $1 million saved, but is that enough? Is that the right number? And these were the questions that I was getting back. So is $1 million enough? Somehow, this is the magic number for most Americans, it seems. And let's try to dig in. Is this the right number for you? It's going to really depend on a number of factors. I don't have an answer for you because I don't know you. I don't even know the answer for myself, honestly, because there are things that I can't predict, unforeseen circumstances. Like what age am I going to retire? How long do I need the money to stretch? How long will I live? What if I think I'll live to 90, but I live to 110? I need more money to stretch, or I have to reduce my expenses at least, right? And a huge factor is where you live. So there was a very interesting article recently in the money section of the US News, and it stated that based on the average household expenses nationwide, so like a whole sort of collection of the expenses, household expenses nationwide, it showed that a $1 million nest egg, okay, should last 23.6 years. So if you take the average of all of the household expenses across the United States, and you have $1 million, based on those assumptions that they made in this study, it should last you 23.6 years. Okay, but here's the real kicker. And that assumes, by the way, like a real return on interest. You have it invested, there's a return on it, and then also minus assumptions on inflation. But when you adjust the expenses based on the cost of living across different cities, that's totally different. So the results showed that retirees in New York City, this is where I am, would deplete that $1 million in 10 years. Okay? Not 23.6 years, but 10 years, that $1 million would be gone, primarily because of the high cost of living and the high cost of housing in New York City. Meanwhile, that same amount of money would last 32.26 years in McAllen, Texas, some town in Texas. So 10 years versus 32 years is pretty substantial, right? That can mean the money could get you to 70 or it can get you to 90. Like that's a big difference. So then how do we know how much to save? We really don't know the answer unless we factor in all of our personal circumstances. So also your health, like how do we know we're going to have good health? If we might have some unexpected health expenses, we need to factor that in as well, right? But still, I think the good news is that we can make some basic assumptions and do some like ballpark calculations and get ourselves close enough to feel pretty prepared for retirement, okay? So the general rule of thumb, is that retirees should take out no more than 4% of their retirement savings each year. So let's say you've got $1 million, 4% would mean that you're living off of $40,000 a year, okay? Can you live off of $40,000 a year? Plus any Social Security that you might get, again, if you're in the US, and any pension you might have. I know not a lot of people have pensions, but if you work government jobs that qualify, you might have pensions on top of your personal savings. So you factor all of that in. If that amount of money, $40,000 plus Social Security or pension or any other amount, if that amount every year would allow you to maintain the lifestyle that you hope for in retirement, then you're in good shape. You're in good shape. But if not, if you can't even imagine surviving on that amount of money because your lifestyle is much more inflated than that, or because your cost of living is really high depending on where you live, then you're going to have to save more, right? It's kind of like a balancing act. Plus, you have to keep in mind inflation. That's going to mean that the money in the future will buy less than it can today. So $1 million today is not going to be the same as the worth of $1 million in 40 years. But we can still make basic assumptions, right? Also, what are your retirement goals? Are you planning to like relax, garden, read books, read all the books you've ever wanted to read, volunteer at the local park, library, what have you? Or do you feel like you're going to be a really active retiree and travel the world and see and do everything you weren't able to do when you were younger? If it's the latter, you're probably going to need a lot more money because there's going to be more expenses tied to that, right? So think about your goals as well. And I know this is a lot. It's heavy to think about, but think of it as for me, it's a fun exercise. It's kind of like daydreaming and planning. I think it's fun. I don't let it really stress me out, and I hope it doesn't for you either. So once you know how much you plan to spend, then you know how much you need to save. Okay, so it's kind of like working backwards. It's almost like reverse engineering. But let's, for the sake of this video, assume that $1 million is your number. How in the world are you supposed to reach $1 million in savings? Like if you're the average Joe Schmo or the average Jane, the American working person who did not inherit money, did not come from money, does not have a whole lot of money, doesn't make $1 bajillion a year. How do you even make $1 million or more? Well, I'm going to tell you, I know it sounds really like almost too simple, but it is kind of simple. You save your money, you invest it, and then you take advantage of compound interest. Like, I'm not kidding you. My husband, he is an attorney and he's a professional executor. He works with high net worth individuals. Those are his clients. He's been doing this for a couple of decades now. He's in a very unique position to see at the very end of a client's life how their investments have panned out and how much, money and assets they have left to pass on to their heirs. And it's fascinating because these are like teachers and nurses, and one guy owned a hot dog stand his entire life. These are like average Americans, and they pass away with millions because they just simply invest and don't do anything crazy, don't do aggressive kind of investing. It's just saving and investing. So I will try my best to break this down for you without making it too detailed. I said before that I've been saving for as long as I can remember, right? I've received questions about how much I save. Currently, I'm probably saving about 30%, roughly about 30% of my income. It has always been between 25 and 35% ever since I paid off debt in my 20s. So once we became debt free, student loans, that kind of thing, all credit card, everything. Then I started aggressively saving, and it's been fun. I think it's fun when you save because it's not like you're depriving yourself. You're paying yourself, and you're paying into your future self. So I hope you don't think like, oh my gosh, now I have to cut down how much I spend. No, you're spending on yourself. You're saving on the most important thing, which is you and your life, your future, right? That's the way I see it. So 25 to 35%, I'll say right now, ballpark 30%. And that has been the case throughout various life stages and various incomes. I received the question, how do you combat lifestyle inflation? I have not done a perfect job of this. I have obviously started to buy things. My whole channel is based on materialistic, frivolous, luxury goods. But generally, the way I've tried to combat lifestyle inflation is that whenever I received a raise or a bonus, I would proportionally increase my savings by that amount, percentage, right? So that's just, I've kind of grown it, and I continue to try to do that, although our expenses have gone up because now we are parents, we have kids and other expenses attached to that, but I'm still trying my best to stick as close to that principle as possible. The key really is automating your savings, okay? I allocate a certain percentage to go into my 401k, which is a company-sponsored retirement account if you qualify for that. I think if you're a nonprofit, you qualify for 403b, I believe. And many employers will contribute as well with a match, so that's free money. When I was younger, I only put in the percentage that the employer would match, like the bare minimum, and I do regret that. I really wish I had put in more. I think the match for my first couple of jobs was like 6%, the first 6%, so I only put in 6% of my annual income instead of maxing out as much as I could. And now I'm maxing out as much as I can. And there is a limit. I think it's $19,500 for the year. You can't go above that unless you're over the age of 50, and then you can do catch-up contributions. But I do regret, because if I had put in more when I was younger, that money would have grown so much by now. Man, oh man. Okay, so automate it, meaning that percentage of money goes out of my paycheck automatically. I don't see it. I don't touch it. I don't have any temptation to play with it because it goes. I also do the same for my personal savings outside of retirement. where I set a recurring automated savings where my bank will just trigger it on the same date every month, and it just goes. So it leaves and goes into my savings, and I don't touch it. So I hope that's helpful. So for beginners, just make sure you set up a traditional bank savings account. Okay, that's like where you want your cushion money, your emergency savings. Right now we have about 6 to 9 months worth of living expenses saved in our emergency savings. That's in a traditional savings account. I'm trying to grow that to 12 months. So I'd like to have 1 year worth of expenses saved in that, separate from our retirement. But everyone's got different. I mean, that's because we have a family. We've got high expenses here. We've got 2 kids. Like, I just like that a little bit more sense of security. That's just me, my personality. But some people say 3 months is enough. You know, it really depends on your comfort. But set up a traditional bank savings account. The interest rate is going to be like peanuts. So low right now. It's like nothing. But still you get something. Like, even if it's like like less than 1%. Still, it's free money essentially, rather than sticking the money in your drawer or under your bed or whatever people do. But definitely have a retirement account, because you can start, you need like either a brokerage account, a 401k, an IRA to start start investing in the stock market, because the returns there will be significantly higher than just sticking it in a traditional savings account. And I will get into that very soon. So if you don't know where to start, and this is all kind of daunting for you, after this video, what I would suggest is that you sit down and you start to write down all of your recurring expenses, like your rent or your mortgage, utilities, phone bill, food, like all the things that you have to pay for. Like, you can't go without shelter and food, right? And see how much money is left over after all of those recurring expenses, okay? And that leftover is your buffer. That's your cushion. And then you decide how much of that money you want to put away in savings. That is your percentage that you determine. It's a target percentage. It's set. And then you automate it. It's very easy to automate it if you do online banking. So I hope that makes sense. Now, of course, if you're living paycheck to paycheck or experiencing any kind of financial hardship at the moment, you may need every dollar, right? And that's okay. You need to live. And, some people are in a position to think about the future, and others are thinking about just today. And if that's the case, I do hope that your financial situation improves over time. But I think that if you're watching this video, most likely you do have some buffer and you can start saving, even if it's baby steps. And if you absolutely can't save today, I hope that this information resonates with you and sticks with you so that you can start saving when you are ready, whether that be a year or 2 from now or down the road. So that's on the saving piece. Then on the investing, I received a lot of questions about how I invest in the stock market. I told you I've been investing since I was about 21 years old. The vast majority of my money, or my stock money, my investments are in index funds. Okay, so if you think about in the US, the S&P 500, that is basically like a basket of the largest 500 public companies in the country. And it's like a mix of their stocks. It's like a mixed bag, basically. And when you think about like diversification, you want to have your money kind of spread out, not invested in one thing, right? Just to, hedge your bets. That is a diversified place to put your money, because that index fund basically mimics the majority of the stock market. Okay, so the vast majority of my money is in index funds. I prefer Vanguard index funds. That's just me. Very low fee. I don't want to give my money away. Management fees, financial advisor fees. So I look for really low fee funds that I can manage myself. You probably know that I am an investor in LVMH. I mentioned that a bit ago. This is kind of rare. So I have a small portion of my money in individually handpicked stocks. LVMH made sense for me because I'm a customer of LVMH, and I feel like I know a bit about the company. I research it often. I looked into their financial track record. And when I purchased their stock the first time, it was a good time to buy. And then I purchased it again when it dipped, and it was a good time to buy. And it's gone up by quite a bit since then. But, it's like if you buy into a brand or a company often, it's almost like paying yourself. comes back around, sort of. But I don't put a lot of money in individual stocks because it's kind of like a gamble. Like you pick one company and you're hoping it goes up. I don't know. Like I prefer the index funds with the diversification. Also, just so you're not taking my word for it, because who am I? Let's think about the most successful, most well-recognized investors in the world, like Warren Buffett. He advises, the average American to put money in the index funds. In his will, it's very interesting. In his will, he advised that he wants, I think it was like 99% of his money, or the vast majority of his money, to be invested in index funds when he passes away, so that he knows his wife is taken care of. Okay. When you hear institutional investors saying that they beat out the market, they're actually saying they beat the S&P 500 or the index funds, because it's kind of rare to do that. And there's like a lot of pride to being able to say that they did that. You could probably beat out the S&P 500 or the index funds, on certain years. But long term, and I definitely believe in long-term investing, long term, it's going to be really, 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 really hard to beat out the S&P 500. Okay? If anything, you're just going to try to mimic it. Your goal is to mimic it, because the S&P 500 has been churning out 10% on average, 10% returns every year. And gosh, let me look at my chart here. Let me see if I can show you, because I don't want you to just take my word for it. I made a chart. And I know people are like, oh, I'm scared to invest in the stock market. Well, you should be, because there's no guarantees. You can absolutely lose your money, for sure. You should know that. But if you don't invest and you just hold your money, you're already losing it. Do you understand? You're losing money if you do nothing because of inflation. Your money is going to be worth less tomorrow than it is today. So if you do nothing with it and you just hold it in your pocket, you're losing money already. So might as well put it in, a steady, proven index fund. So let me show you here. This is the S&P 500 annual returns for the past 10 years. These are the returns, okay? And it's up and down, and you have to be able to stomach the roller coaster ride. If you are going to invest and then freak out and pull your money out when it dips, you're going to lose money, okay? This is for the long haulers. Here, I wrote it all down so that I don't go off of my memory. Over the last 10 years, average over 14% returns a year, okay? Average. Since index funds were created in 1965 up till 2019, the average returns were about 10%. And then you go, but what about last year, 2020? It's been crazy with COVID and all of that. Well, even after there was a major sell-off of stocks in February, March, when COVID first hit and there was panic, the annual return for 2020 was 16.26%. Okay, 16.26%. Are you getting 16% by putting your money in a traditional savings account? No. Are you getting 16% by sticking the money in a jar? No. So you get my point, right? I'm kind of being cheeky here, but you get my point. Then we're moving on to in my opinion, the most magical component of investing, which is compound interest. So I created more charts. Let me just grab them. So since I showed you the average annual returns on the S&P 500, and I told you I'm a big believer in index funds, particularly Vanguard because of their low fees, I want to show you what happens to your money when you invest, assuming those 10% annual returns, okay? It's just an assumption, 10% across the board. Okay. So I made this, and don't look too closely at the numbers because they may be off by $1 or $2 because I just quickly calculated, but it's largely very, very accurate. Okay, so these are the names of the people that my daughter came up with. Rosie and Bella, she was helping me, so these are hypothetical people. Rosie invests $3,000 a year, starting the age of 21. So she comes out of university, gets her first job, and she manages to put together $3,000 a year, probably in bits, okay? Let's just imagine realistically. So it's $3,000 a year, and she does that all the way through until she's 30. But then, life circumstances, I don't know what happens. Maybe she gets married, expenses go up, and she's just not focused on saving. So she stops, okay? So from 21 to 30, she saves $3,000 a year, and then she completely stops. And these are just the calculations based on 10% returns. So she would wind up having about $52,500 at the age of 30, okay? This is compound interest. The reason why it grows so fast is because compound interest is interest upon your principal amount, as well as interest on top of the interest that you earned before. So it's like compounding. It's constantly accumulating very fast. So she starts here, and then at the age of 30, she's at $52,500. Then you've got Bella. And Bella is partying it up and living it up in her 20s, doesn't give a hoot about saving, isn't even on her radar. She's just having a blast. But then she turns 30, 31, and it starts to sink in like, oh, I'm an adult, real life. I got to save. I want to buy a house, or I want to invest and blah, 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 right? So then she does the same thing as her friend Rosie does. She saves $3,000 a year. But starting 31, she continues to save $3,000 a year. Okay? And she keeps saving until she's 65 when she wants to retire. Assuming both receive 10% returns a year, let me ask you this, and please put your answer in the comment section without cheating. Who do you think will have more money at the end? Rosie or Bella? Rosie saved for about 10 years and stopped. Bella did not save the first 10 years of her adult life, and then started all the way until the age of 65. So let's say they're both 65 now. Who has more money? Can you put that in the comment section? Here's the answer. With compound interest, Rosie did not save from age 31 to 65. She did nothing. But this money continued to compound. At the age of 65, she's a millionaire. She's got $1.4 million and then some. Bella, poor Bella, she tried so earnestly, and this is obviously better than nothing, of course, but she saved every year diligently, and she's got a little bit less than $1 million. So she's not quite a millionaire, but she's close. She's got $978,000. Why? How in the world? Because Rosie had 10 extra years of compound interest. That's why. She got a head start. So the sooner you start, the more amazing compound interest is. I hope this makes sense. I really do. I think it's profound. There are a lot of examples like this that my husband put in his book. So like I said, I'll reference his book later, and I'll also put it in my description box if you want to pick that up. It's a very simple read, thankfully. Okay, we're almost done. I want to show you an even more amazing example here, okay? So, I just wrote here, assuming 10% returns per year. Okay, so now we've got Emma and Susan, two other names that my daughter gave me. So Emma saves $3,000 starting the age of 21 and continues on until age 65, okay? She's just very, very diligent. It's not realistic because your savings will most likely go up and down. But let's just say $3,000 every year starting the age of 21. Good for her. Susan is a little late to the game, okay? And she goes, oh my gosh, I am 40 now. I have not saved a dang penny. I need to start saving. I think I should save double what I would have saved. So she was going to save $3,000 a year, but she pushes herself and she doubles it. And she starts saving $6,000 a year, okay? That's kind of a wise decision, right? Like you want to catch up. Who do you think has more money? The one who doubled their money and saved all the way until the age 65, or Bella, who saved half that money but for a longer period of time? Look at this. This is incredible. Emma, who saved $3,000 a year for 45 years, assuming 10% returns if you were to have your money in the stock market, in the S&P 500, in an index fund, etc. She's a multimillionaire. She's got over $2.5 million by the time she's 65. Okay? And $3,000 a year is not impossible. That is, I'm sure many of you can save well over $3,000 a year. Some of you can save $3,000 a month, okay? Some of you can save $6,000 a month. So you've got Susan, who was diligent, but she missed out on 20 years, okay? The first 20 years, she didn't do any saving. But still, she tried. You got to start somewhere. and she doubled it to 6,000. But unfortunately, the way compound interest works, because time is the biggest factor, she is left with $700,000 when she retires at the age of 65. Look at the difference. One is a multimillionaire and one is not. Okay, that is compound interest. I know I'm sort of harping on this, but there were so many questions like, why is compound interest so important? What is it and how does it work? And how are you so sure that it's the right thing to invest in the stock market? It's scary, I know that. But my biggest regret financially is not putting more money in the stock market and not putting more money in the index fund when I was younger. That's my biggest regret. I know some of you asked me that. What's something that I would, undo? And that would be it. And panic selling. I did panic sell during the mortgage crisis. I also was too scared to buy when everything was low, so I do regret that. But the biggest regret is not starting early and taking advantage of compound interest. So I want to kind of end on that note because I think it is probably the most important message I want to get out there. Never too late, but also never too early, and vice versa. Let me just check my notes here to see if there's anything else. There were so many other questions, but I can't get into everything in one video. We're already running over half an hour at this point, and I want to keep your interest, and there's nothing to really look at. There's no eye candy. So I know that it's probably hard to stay engaged. I do hope that this video was helpful, and if it was in any way, that you would give it a thumbs up so that I know, and then I can consider planning more videos like this. I have thought about doing like a finance series, maybe putting out a finance related video every Friday or every month. Maybe every Friday is too ambitious. But there has to be enough interest, and I don't know. You let me know what other topics you want me to dig further into, what other specific questions you'd like me to cover. I know I wasn't able to cover everything. In terms of my personal investment portfolio, I can put together a pie chart and just show you percentages of how my money is invested at the moment. If that's something of interest to you, maybe I can follow up with a future video sometime soon. But I promise to share some resources. There are 2 YouTube channels that I'm really a big fan of, and I believe in not all, but largely most of the principles that they share. The first one is Investing with Rose. She's also a Korean, which is kind of a coincidence. Investing with Rose. She is got a really level head, and she shares very similar saving and investing beliefs as I do. And the other is Our Rich Journey. Beautiful family. They retired early. They're millionaires. They have just recently moved abroad to Portugal, and they are chronicling their life there, which is really cool. But they too also, they really tout index funds as well. There are other YouTube channels, but I feel like they're so financy, if that makes sense. Whereas Rose and Investing with Rose and Our Rich Journey, they're more relatable, normal people, and they just kind of talk about their tips and tricks and trial and error, mistakes and successes. It's just more real life, and they're not financial professionals. And I have nothing against financial advisors. We have really close friends who are financial advisors. I did use a financial advisor once in my life. I no longer do, but if you can educate yourself and empower yourself with this information, then you are more than capable, absolutely more than capable of managing your own money without having to pay extra fees to someone else. Then lastly, I promised to share my husband's book. I know this is kind of personal. I didn't know if I wanted to do this, but I really just am sharing this because I feel like it would be helpful to you. This is the paperback version, which is really an easy, light read. It's got bold headings, charts, examples. It's kind of easy to underline and take notes and highlight and such. It's called How to Invest for Retirement, A Simple Path to Retiring Rich, Independent, and Free. And like I said, my views really mirror very closely my husband's. We're pretty much aligned, I'd say 98%. And that's him, my hubby. Like I said, he's an attorney. He's a professional executor. He's worked with high net worth individuals for many, 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 many years. He's got his own practice, and he's in a very unique position to be able to see at the very tail end of someone's life, when they're passing and when they've passed, how they have invested and how the money has grown and what's worked and what's not. So he kind of gets to see it in reverse, which is really kind of cool. And I'm telling you, index funds like Warren Buffett says, is the way to go. But this book will answer a lot of the questions that I haven't been able to touch on. And he's a very clear writer. So it's like, I was like, this needs to be like kindergarten level if I'm going to read it, because I can't get into like all the jargon. And he was like, yeah. So this is pretty good. It's available on Amazon. You can pick it up there. I'll put a link down in my description box below. I'll also put a link to the 2 YouTube channels that I mentioned. And if I think of anything else, there is the MoneyChimp. It's a funny name. MoneyChimp compounding calculator. I actually have it on my phone. I have it saved as a favorite because I use it so much. I can't show you because I'm filming with my phone, but just go to MoneyChimp compounding interest calculator, like Google that, and it'll come up. I'll also try to find the link and just put it in my description box, and just click on it and save it, because you can play around with the numbers, put in certain numbers and see, like in 20 years, how much would that be worth, assuming a certain return on it. And it'll give you a rough idea, because you don't want to be completely shooting in the dark here. We don't know for sure. Can't predict life. But you want to be able to guesstimate as close as possible, right? So thank you so much. If you have been with me all the way through, now we're over 40 minutes. Wow. Thank you so much. I know this video was highly requested and it was long overdue. So thank you for your patience, and thank you for your interest, and thank you for your trust in wanting to even hear my point of view on this stuff, because I'm the handbag lady. But this is a part of my life that I'm super passionate about. I have been incredibly dedicated to financial empowerment and education, especially for women, for a long time now. This is a topic that I can talk about forever, but I will end it here. Let me know what your questions are as a follow-up, any comments you might have. And again, if you'd like me to do a series of these kind of videos in the future, I'm open to considering that as well. Thanks so much. Bye.